Okay, I think we're going to get started. I want to welcome everyone to another edition of our CIRA webinar series here at W&G. The topic and title of this quarterly webinar is the importance of financial planning and the creation of a written investment policy. So it's very exciting. We're excited to present this topic. You know, we're all pretty passionate about what we do in financial management, both as CPAs and we have Rich Hausler, which I'll introduce in a minute, and on the investment side. And, you know, we're pretty passionate about how important financial management is and how important the investment policy is. So, you know, we're excited to be here. So I want to thank you for joining us. My name is Joe Chorba. I'm a principal at Wilkin & Guttenplan. I'll be your moderator for today. And like I said, today we'll be covering a topic that really should be a vital part of your management of the finances of your association, whether you're a manager or a board member or whatever. You know, this is pretty important. You know, having an investment policy and sound investment strategies are important both when rates are low and even more important now when rates are starting to creep up, that we maximize the return on all of your investable assets. So by the end of the program, we're hoping that you have a few takeaways that you can go back and to your boards and your communities, and hopefully will help improve your financial management, you know, short term and long term. So I'll introduce the speakers. We have two wonderful speakers for you today. We have Maria Mauricio, who is one of our rising stars here at Wilkin & Guttenplan. She is a vital, integral part of our staff. She does a wide range of services. She works in audit, tax, and consulting services for closely held businesses, condos, HOAs. She's also part of our 401k audit team. She helps train some of our entry-level staff and interns, she does a lot. She's also written for our quarterly CPA newsletter, so she's a fantastic staff, and we're happy to have her. So thank you, Maria, for joining us. We also have Rich Hausler, who's also going to be a part of our panel today. Rich is the Vice President of Wealth Management at UBS Financial Services in Manasquan. Rich has over 30 years experience. We were chatting before we started the broadcast, and you know, I knew Rich had a lot of experience and had a lot of knowledge to offer, but you know, it was even more. Just chatting with him, it was even more than I even expected. With over 100 properties and over 30 years of experience, Rich really has a lot to offer. So he's a great speaker for us today. Rich has been an active member of CAI for many years, serving on various committees. He's also, like myself, has been a glutton for punishment and decided to be the treasurer of his board at his community. I joke, but it's really it was a great experience for me, and I'm sure Rich will say the same thing of seeing the other side of what a board has to do as board members. So he also brings that side of his experience as well. So we're going to get to all right. So before we get to some of the material, I just want to go through some housekeeping for everyone. So you'll have the ability to ask questions, so ask as many as you like. You'll see a questions pane on your GoToWebinar dashboard on your screen. Ask as many as you'd like. We'll try to answer as many as possible that kind of fit into the flow of the webinar as we're going through the material. If we don't get to your questions, don't worry. We will make sure that we respond to your questions after the webinar. For any questions that we don't get to, the three of us will make sure that we respond to your questions. So ask as many as you'd like. We'll also be having some polling questions throughout the webinar. This will just help us get a sense of the audience as a group and their thoughts on some of the topics. So look out for those. I think we have 2 or 3 polling questions throughout the hour. And also, if you have to step away or if you miss any of the program for any reason, we'll be recording the webinar, so you'll be able to watch it on our website. It's usually up within a couple days, but we'll make sure we let you know when it's up on our website, ready to be viewed. Okay. So some of the goals for today, I talked about some of the takeaways, hopefully that you'll have by the end of the program, but some of the things that we'll be going over for you to learn and understand the financial management responsibilities of the board, and this is all, with respect to investment policies and investment strategies and some of the responsibilities of the board as it relates to those, the overall importance of long-term financial planning for associations, where you reside or manage, how to develop an investment policy, and some of the things that should be in there, and also we'll talk about some of the people that you should get involved when developing your investment policy. And then, the second half of the program, we'll also be talking about some investment strategies. So once you have a policy, you'll want to come up with some strategies that fit into that policy to try and maximize the return within the parameters of your investment policy. So we're going to go through that as well. So I think we're ready to go, but we're ready for our first polling question. So this will just get us started. So pretty simple question. We're just kind of curious to see who in the audience has an investment policy. So does your association, where you manage or live or you're a board member, do you already have an investment policy? Or is it something that you'd like to have or develop? I'll give you a couple more seconds to answer. Okay, so it looks like we're pretty split. So we have actually we have about 60% of you said you don't have a policy yet. So I'm glad that you're here because, like I said in the beginning, we're passionate about financial management, and we do see the importance of having a policy. So hopefully you'll be able to develop one with some of the tools that we'll give you today. And about 40% said you already have one, which again, I'm happy that you're here as well, because we're also going to be talking about the management of that policy and updating the policy and things like that. And hopefully you'll also get some takeaways where you can kind of revisit your policy and see if it needs to have any amendments or changes. So we're about 60-40. Okay. So now I am going to turn the program over to Maria, who's going to talk and get us going with the investment policy and some of the background. So Maria, take it away.
Thanks, Joe, for that intro. So before we get into the actual written policy topic, I'm going to go through some background about fund accounting. So it's kind of known that CERAs, which are the condos and cooperatives, use fund accounting to budget, track, and manage finances. So when we talk about funds, I kind of attribute it to different types of buckets with different types of purposes. So you really wouldn't want to commingle any of your different fund cash accounts, because the idea is kind of to use the funds to manage your cash flows. So just different types of common funds that we see is the operating, which is your day-to-day operations of the condominium, all that. And then for maintenance, it's for expenses that occur less frequently than annually. So that would be kind of your power washing, your painting of the units, and also mulch is a common one too. And then finally, there's the replacement fund, which is for future replacements of major common area components. So this fund is more of roof replacements, roads, concrete, sidewalks. And then just to dive into the replacement fund, this is kind of the fund where there's money to invest. So just to think about it, because these large roof replacement projects and the sidewalks, they kind of cost upwards of hundreds of thousands to even like maybe millions, depending on the size of the condo. So with all this cash accumulated, investing wouldn't hurt, as it will give some interest income to associations to even use for even unexpected replacements that weren't, in the reserve study. And also it kind of offsets inflation and, any other unexpected replacements. So you can really never have enough cash, because more times than not, replacements somehow always end up costing more than expected. So then, of course, like any other financial decision, the boards kind of make these financial decisions. It's really important to remember that boards are acting in the best interest of all unit owners, not just their own interests. It's their fiduciary duty, So in terms of investments, board members shouldn't let individual risk tolerance or investment biases influence the association's financial matters. So, avoid investing in high volatility and high risk instruments, which may be contrary to investing in one's own personal money. So it's always, the goal here is always to protect the principal, which is kind of to limit the risk and to maximize gains within, the parameters of your principal amount that you initially invest in.
So Maria, I just want to back up one second, because we're talking here a lot about the replacement fund and investable money in the replacement fund. So I guess I'll just a question for Rich on this too. How often do you see other funds that have investable money as well? Because I know I've seen it in some of the audits that we do, that I guess with the investable cash that you have in the operating fund and the deferred maintenance fund, I think the key is, and you'll talk about this when you get to your investment strategy, is making sure that you're managing your cash flow with these investments, and that you're making sure that the liquidity of these investments are in line with the needs of the different funds, the replacement fund and the deferred maintenance and that kind of thing. So I don't know if you have any comments on that.
Thanks, Joe. I would just say that even for some of the shorter-term funds like deferred maintenance or even operating in some cases, quite often short-term CDs can be used as a cash management strategy where quite often expenses might occur maybe in a 3, 6, 9-month time frame. So you can use laddered CDs in a short-term format to obtain a better return and keep the funds insured in FDIC instruments by using those types of securities.
Right, exactly. So while your replacement fund is probably your largest bucket of investable assets, I think it should, some consideration when you're developing your policy and your strategy, some consideration should be also put to the other funds that Maria introduced us to, in the operating fund and the deferred maintenance fund. For those reasons, you may have some investable assets that, based on the cash flow needs, you may be able to get some return on those too. So, okay, Maria, you want to?
Right, and going off of that, I feel like one of the more common mistakes that boards make is the proper documentation of all this. So, even within just the minutes and even writing the investment policy, there might not be any documentation of the financial decisions that were made from past board members or current board members. So, just to give an example, maybe a board member is investment savvy, and they know what types of investments that they can risk, their risk management and all that, like what types of CDs that they can invest in. But then when they leave, the future boards may not know, and they won't have the proper documentation of what happened, why did they make these investment decisions, where does this come from, and all that. So that comes up with, why do we need a written policy? So going back to that example, board member leaves, doesn't provide consistency and longevity of investment strategies. Future boards, they try to act, with the best interest of all the unit owners, but maybe because of internal biases about, investing and being, low risk or not maximizing their gains, it can be inconsistent from board member to board member. So having at least a written policy in place, they can go back and see, okay, this is how much risk we're willing to take. This is how much money maybe that they're willing to spend on insurance, FDIC protection, all that. So it provides consistency and longevity. It also provides accountability. If there's something written again, you can go back, a unit owner can go back or any board member and say, okay, you're acting within your parameters of a board member. And next, it protects and ensures the safety of association assets. And of course, it provides guidance to current and future board members that may not have that investment savvy mindset. And then the next few slides are kind of the steps that that may or may not be applicable, but they're a good start into how to develop your written policy. So this first one is to obtain and review permanent documents. This may be overlooked sometimes as, there's a lot of governance documents depending on your condominium association or your cooperative, but it definitely helps that you have a collaborative effort with your attorney through this first step, to help sift through the government documents and permanent documents and highlight the areas that might be relevant to develop, the policy and any further financial strategies. Because the worst thing is going through your bylaws or your POS and then going through your investment policy and seeing that there's contradictions. It might cause disarray with current or future board members asking, why does one document say this, whereas a different document says otherwise. So lessen the confusion. And then going off of that, taking into consideration the permanent documents, determine the level of safety, risk, and insurance protection. Understand the limitations or the guidelines from the government documents, like how risky are you willing to take your investments, which might be actually a strategy point afterwards, after writing your investment policy. Taking into consideration your FDIC protection and all that. And then the third step is to include the timing of current and future replacement needs when choosing an investment vehicle. So this also may be overlooked because sometimes engineering studies you don't really think about it as an investment, as part of your investment policy, but really, for example, if roofs are, to be replaced within the next year, the association wouldn't want to invest in a long-term investment. Maybe instead do a 12-month CD, 18 months, and vice versa. If no major projects are scheduled for the next several years, then the association can't afford to invest in long-term policies. And the one way to, combat that or actually plan your investments is to have an engineering study done and to update it within every 3 to 5 years. Because within that reserve study, the engineers look at inflation and other, unexpected or expected replacements, and also manages kind of the cash flow of the next 3 to 5 years. And the fourth step is inquire with investment professionals. So when writing this investment policy, I like to think of it as like a collaborative effort. It's not just the board trying to figure out themselves and then maybe just a financial advisor. It takes, your accountants, your lawyers, your engineers to, develop all these things, because they all have the knowledge and experience of, what to recommend and what to advise to put into your investment policy. So, the common types of investments, the safety, the average rate of returns, which might be actually an investment you can consider for the investment policy, but it's more towards afterwards, like the investment strategy of the association. And then any other thoughts or concerns that may come up when you're talking to your professionals. So the fifth step is kind of to draft that with everything above. It should be clear what you can invest, what investments are permitted or maybe not permitted, who makes these decisions. Is it the treasurer, is it the president, is it all the board? You have to vote on it, and how to monitor the investment portfolio. Do you look at monthly statements? Is it quarterly? Is it annually, biannually? Have to be very clear as to, what are the steps, who's going through it, and when are we monitoring. And then the sixth step is going back to your attorney to make sure to review the policy. Again, just to make sure that the policy is clear, concise, sound, and also not contradictory to your governing documents. The seventh is your CPA firm should review the policy. As accountants, we kind of make sure that, as consultants too, not just CPAs, we kind of make sure that the association is following the best practices of the industry while also maintaining the long-term financial management goals of the association. And then eighth is to finalize the investment policy. Ninth is to make it part of the permanent documents. And then 10th is to develop an investment strategy based on the policy itself. So basically the bottom line is a written policy will guide boards for years to come. So again, just harping back to, the investment savvy board member. Once he or she leaves, their knowledge leaves with them. And without having something written down, either through the minutes and of course through a written policy, it's hard for board members to not replicate, but be consistent with how they're investing their money. You know, because if someone's not investing or if someone's not investment savvy, you know, it could harm the association's principle that they've invested in. You know, it holds boards accountable, and it guides the future board members if there's something written and there's something, you know, they can be held accountable for. And of course, I almost want to say that it kind of eliminates the confusion afterwards. Like, if there's something that you can go back in permanent documents, it's written in stone unless it's amendment. So most of the confusion, you know, should be eliminated. And then also it goes back to the fiduciary duty of the board. Are they acting in the best interest of the unit owners and not just themselves? And of course, you should really ask your professionals. Again, it's a collaborative effort. It's not just the board members deciding that, hey, I need a written investment policy, let's draft one up based on something they heard here and there. But I mean, attorneys, your accountants, your CPAs, your financial advisors, even your engineers, they all have experience. We all have experience. We all know, you know, what the best practice is for your type of condo. And at the minimum, these are the 4 professionals that should be consulted.
Yeah. So thanks, Maria. So
No
so the common theme and everything, and I know you've probably heard it a million times, is communication. I mean, that's really what it gets down to, and the common theme and everything that Maria was talking about, and involving as many people in that communication as possible, and making sure that it's a clear, transparent investment strategy. Involving your attorneys, accountants, financial advisors, engineers is all important. And it's not only in developing the policy, and like Rich is going to go over, it's maintaining that policy, making sure that things are updated, that if you have a new study, that study is given to your investment advisor to make sure that he or she is investing consistent with the policy and the engineers, and that you review your policy periodically. So all of these things are great. And the other piece of that communication is when you are making your investments, like Maria said, making sure that it's properly documented, so that you can you know, show that the actions of the board are consistent with what the policy, the approved policy is. So thank you, Maria. I'm gonna turn it over to Rich for a bit now. Rich is going to kind of shift gears a little bit on from the policy to more of now implementing a strategy. It's going to be some policy, a little bit on policy, but it's going to be mainly on the strategy and implementing that policy. So, Rich, it's all yours.
Thank you, Joe. The financial responsibilities of the board may be their single most important area of concentration. This will invariably result in difficult financial decisions and periodic increases in homeowner association fees over time. While these may not be the most popular choices, it is critical to keeping up with inflation and related increases that are sure to exist over the life of a property. These are quite often some of the tough decisions that the board members face and have a responsibility to address head-on. I would suggest that the board make the financial matters of the association an ongoing primary concern and stress the importance of the treasurer's role in keeping this topic front and center on its regular agenda. It is incumbent upon the treasurer to have a thorough understanding of the financial structure and play an active role in leading the association in this area. There should be a backup person designated in the event the treasurer is unable to carry out their duties. Some of the key responsibilities of the treasurer's position include: review all monthly disbursements and ensure their validity, review monthly financial statements, serve as chairperson of the finance committee, monitor investments to ensure that funds are invested as efficiently as possible, maintain a direct line of communication with the financial advisor to ensure that any material changes or relevant information is provided to the advisor, and that recommendations provided by the advisor are acted on in a timely manner. Provide financial updates to the board on a regular basis. The next few slides will discuss investment strategy, which often takes the form of an investment strategy statement. The investment strategy statement provides guidelines for maintaining accounts, investment risk limitations, and securities selection criteria.
Oh, okay, perfect. Good, Rich. So on investment strategy, we can get to our second polling question, which is we kind of want to get a sense for those of you who have a policy already and those of you who are looking to have one, what's your primary focus? So what do you consider the most important factor when developing an investment strategy? And obviously all of these would be within the parameters of your policy, but is it to maximize your return on investment, preserve principal, or to provide liquidity for all of your anticipated expenses, kind of like what we talked about before, looking at your reserve study and your deferred maintenance needs and maybe some of your operating cash, which is sometimes hard to come by, but if you are lucky enough to have some investable operating cash, you know, is your primary concern providing liquidity for those anticipated expenses, preserving principal, or maximizing your return? Okay, so I'll give you a few more seconds, but we have the results are pretty consistent. It looks like everybody's, or a large percentage of you are answering, you know, consistent manner. So, okay, so we'll close the polling. So, wow, so about 65% of you said that your primary focus is to preserve principal. About 20% is providing liquidity for anticipated expenses. And about 15% is to maximize your return on expenses. So, so that's good information. And it's, you know, I've heard all three of these when I meet with boards. I've heard different boards have different focuses, and they're all connected. You know, obviously preserving principal that's one of the goals, and sometimes it's a challenge trying to get investments that have a high return and still preserve principal. But they're all connected. They're all important. But Rich, I'm interested to hear what you have to say on what you think is the more important, or how you would rank them as far as the three.
Right. The polling results are interesting. I'd say they do match what you would expect. Number one, from a fiduciary responsibility, certainly the protection of principal being the primary concern. So that makes sense, Joe, that was I guess the primary focus. And then, of course, maintaining liquidity. We know it's important to make sure money's available when it's going to be needed. And then lastly, of course, the investment return. Although my main comment about this would be that the investment return piece is really quite often somewhat neglected. And I think it falls down, as it did here a little bit in the polling, but that's an area that I would say it should be every association's goal to try and increase the level of concern for that as well as, you know, the other two items.
Yeah, and one of our listeners made a point that all, I guess in his opinion, all 3 points are equally important. And, you know, I don't disagree with them. They are all very important. And I guess the, you know, I guess we were curious to see where the audience fell as far as their level of importance on each of these three. And it was interesting, the results. But again, like Rich said, they're all important, and making sure that they all fit within the parameters of your total investment policy. So, yes, we can.
Okay. The investment strategy statement is a document that spells out the general investment structure of the association with regard to the various targeted investment accounts. It should be used as a backdrop to help maintain a strong financial foundation for the life of the property. The investment strategy should address the following key issues. Identify the targeted short-term and longer-term accounts. Identify funds that can be invested. Discuss and implement appropriate investment strategies. Provide periodic review of accounts and performance. One of the key benefits should be reflected in the return on investments over time. The investment strategy statement guides the board regarding their financial duties and spells out the specific guidelines related to the various accounts. It is also a mandate for future boards to ensure smooth transition as the property ages and board members change. An investment strategy can be prepared by a financial advisor, the association's attorney, accountant, or perhaps a management company. The document should be reviewed by the association attorney before being adopted and implemented, as this was mentioned earlier as well.
So, Rich, I know we kind of talked about this a little bit before and some of the things to look for, but when you're reviewing a policy, what are some of the things that you look for in that policy? What are the primary things that you focus on when you're reviewing a policy or a proposed policy?
I'd say the most important thing is determining the different types of accounts and maybe how long funds can be invested within those. So first, you'd certainly have, the operating, which is typically a check book type of an account, a cash management type of an account. Quite often there's excess operating funds that tend to sit in an account that might not earn interest or much interest. So there could be an area there that could be beneficial. And then looking at the deferred maintenance and working capital, those are typically a short to intermediate term accounts. So making sure that the boards realize that there's monies within those accounts, again, that can be invested and quite often could be invested over a period of years. And then, of course, the replacement reserves, which would represent the much longer term expenses, and really focusing on having a strong investment strategy, mainly in the reserves, because that's where the bulk of the money would be for any association, and the greatest earning power, therefore, on the monies that association would have to work with.
Now, I know you're going to get into a little bit on some of the different types of investments that, or maybe we can kind of table it till then, but I guess, do you ever, how much do you consider external factors like different market trends or different economic factors that you may be seeing or may be projected out over the next few years, whether interest rates or bond rates are low at this point, and how does that affect your total investment strategy? And you may get to that a little bit when you talk about some of the different investments, but how much do you consider external factors that may affect the different rates or potential investment performance on your investments?
Right. Okay. No, that's a great question. It's factored in to a degree. I would say that it's very hard to predict quite often or forecast the direction of market changes or interest rate changes. There are periods of time where we can see the Fed moving in a particular direction, as evidenced by the period we're in right now, where we know the Fed has begun to increase interest rates. And typically, when a trend like this begins in either direction, there usually is a timeline that it will occur over. So I do take that into consideration quite a bit when those situations seem to be presenting themselves. But secondly, I would say that especially with the reserves, the strategy that's most commonly used with fixed income investing is laddering or staggering the maturities of investments over time. And it's been proven when investing in fixed income securities that the laddering strategy should add to your overall return over time using that strategy versus just staying short term or hoping that rates move in the direction that you anticipate. So I would say to a large degree, the laddering strategy is used, and not necessarily that much concern given to the other factors going on outside of that.
Great. Yeah, I would agree with you on the laddering is a more consistent and it's impossible to predict where markets are going to go, and laddering, I agree with you, is probably the best strategy and the most consistent return from your investments. So
great. Okay. One of the critical elements of a successful investment strategy is diligence. It is important to ensure that investment return is maximized by following the established investment strategy and maintaining money market balances versus longer-term securities, minimizing money market balances versus longer-term securities. Investments need to be closely monitored so that maturing securities are quickly reinvested. There should also be special attention paid to rising money market balances due to monthly contributions and earned income throughout the year, which offer additional opportunities for investment. By limiting low-paying money market balances and investing in short-term securities such as CDs, you can significantly improve your investment return. Laddering within a one-year time frame may provide a periodic cash flow to cover anticipated expenses. For intermediate term assets, based on the current interest rate environment, my typical recommendation would be to maintain an intermediate term laddered portfolio not to extend beyond 2 to 3 years in maturity. This investment strategy will allow for participation in the positive spread of short-term rates versus low-paying money market funds, while avoiding the risk of committing funds long-term at historically modest interest rates. Regarding longer-term assets, the two most popular long-term fixed income investment strategies are laddering or staggering of maturities, and the barbell, which combines both short and long-term maturities. Both strategies are best suited for properties that have adequate assets and can diversify its holdings. An example of laddering would be CDs invested in 6-month intervals over a 3 to 5 year time horizon, while an example of a barbell would be CDs laddered out 2 to 3 years, combined with 7 to 10 year maturities on the longer end of that barbell.
Rich, I just want to stop you can you just expand a little bit on the laddering versus the barbell? And I know you gave us a couple of examples, but can you maybe expand on it a little bit and maybe give us an example of a situation where you would prefer to use a laddering strategy versus a barbell strategy?
Sure. A laddering strategy may be more appropriate in a situation where there are going to be a lot of near-term expenses or maybe within a 5-year time frame. So the association may not be able to extend out further than a certain window of time. The laddering strategy may also make more sense in a rising interest rate environment like we're in now, where we have a pretty fair expectation that rates may continue to go up, even though very gradually, maybe over the next year or two. So it may make more sense to maintain a ladder that's shorter term versus a long-term scenario. In terms of the barbell approach, that may make more sense in a lower interest rate environment, where you'd want to keep a certain amount of the assets on the shorter end of the investment. So again, maybe in a 1, 2, 3 year time horizon, and then you invest some of the assets longer term, perhaps even a 7 to 10 year maturity, where even in a lower interest rate environment, typically those longer term investments are paying a much higher interest rate. So that gives you the barbell effect. You have half of the portfolio within a short-term time horizon, and you have the other half of the portfolio maybe in a longer-term time horizon.
Okay, great. Thank you.
Great. The benefits of long-term assets. Long-term assets provide greater overall earned income, increased cash flow, limit reinvestment risk in downward rate cycles, increase earned income in rising rate cycles, and provide a greater overall return.
Are we, okay. Okay, so I think, there we go. Oh, okay, so, no, it's okay. So we have our one last polling question before we we come down the home stretch for the last 15, 20 minutes. And this kind of gets back to what we've been talking about, throughout the program. And the question is, how often does your board review their investment policy and strategy? So, we've talked a lot about developing that policy and developing a strategy, but it's also really important to maintain that policy and strategy. Like Maria and Rich both said, and boards turnover, managers turnover, even your professionals may or may not turn over as often as boards may. But you have your investment, your other professionals, attorneys, accountants, whatever they may be, they may turn over from time to time as well. So it's really important to make sure that you do update your investment policy. So I'll give you a few more seconds. About 50% of you responded. So a few more seconds. I'm just curious to see where you are with your updating and maintaining your investment policy and strategy. Okay. Okay, so it's pretty spread. So we're about 38% of you said often, which is biannually, which is maybe once or twice a year, or twice a year. 33% of you were periodic, which we defined as annual, would be periodic. And then rarely or never was about 29%. So it's pretty spread out. I'll let Rich comment on the results and what his thoughts are as far as updating it, but I certainly think this is important enough, and both in your low interest rate environment or rising or high interest rate environments, I think the idea is, like we talked about in the beginning, is making sure you maximize your return on investment in whatever environment you're in. So reviewing your policy is important, but I'll let Rich comment on the results and what his thoughts are on how often it should be looked at.
Right. Okay. Thanks, Joe. I'd say it's very encouraging that 2/3 of the respondents replied that they review it at least semi-annually, if not annually. So I think that's excellent. I would say that an investment policy should be reviewed at least annually, and possibly semi-annually, and maybe more in the beginning when an association is first implementing this and getting comfortable with having the policy and trying to be a little bit more diligent, about managing the funds. It's interesting that 1/3 of the respondents replied that they maybe never, and that might speak to the fact that a number of you don't have an investment policy. So that jumps off the page a little bit at me and would indicate that this could really be an area of concentration going forward that could really add value to your properties.
Yeah, and just to stick with this for a second, when you're updating your policy and you're reviewing your policy with your professionals, it doesn't, I don't think it has to be as full and detailed, obviously, as when you develop the policy, but I guess when you're updating the policy or reviewing the strategy, Rich, what would you say are the most important things that you need to be looking at when updating the strategy or policy each year? If we're saying we should be looking at it at least annually, what are some of the things that we should be focusing on when we are looking at it on an annual basis?
I would say mainly just making sure that and this could dovetail into a little bit, just that the reserve study is up to date, and that outside of the reserve study, sometimes projects are moved up or done in phases. So just the board really having their arms around that to, again, it could be an opportunity to invest a little bit differently or maximize the return if some things within the reserve study or anticipated expenses change. Secondly, your awareness of the investments that are available. Now, as fiduciaries, your investment horizon is typically very limited to funds that need to be insured. However, even within the world of CDs, there are different types of CDs. So besides the standard CDs that most of us are familiar with, 1 year, 2 year, 3 year, 5 year, etc., there are also step-up CDs. Step-up CDs offer a graduated interest rate over a period of time, whether the Fed raises interest rates or not. Quite often, they're a little bit more intermediate term, maybe 5 to 7 years. However, they could very often give you a better return than, again, just the regular straight standard CDs. There are also market-linked CDs. Market-linked CDs are also FDIC insured, but they're linked to some sort of a market or growth index, which will give you an opportunity for a higher rate of return. These are often a great hedge to a totally fixed income portfolio. So I would say as boards evolve and their level of experience grows and that type of thing, they just avail themselves to these other kinds of opportunities and just make sure that they're keeping up with any changes in the industry and things like that.
Yeah, I agree. Those are important because you want to, like we said, maximize your return on investment and knowing some different investment vehicles that are available to you. You know, that's important too. And also on the flip side of that, you mentioned making sure that the study is updated, making sure that you also manage your liquidity. So if things do come up sooner than you expect, that you're sure that you communicate that with your investment advisor, that you know, that they're not, I don't want to say on autopilot, but if they're not, that they're following the policy, but also making adjustments or changes when things don't go according to plan. So they're both important on both sides, making sure you take advantage of new opportunities to invest, and also making sure that that you're staying consistent with the plan and adjusting for things that do arise.
Okay, so just to kind of recap some of the benefits of active financial management. Active financial management helps defray long-term expenses, could avoid or diminish fee increases or assessments, and establish a proper legacy for the property. Financial planning is an ongoing process. It involves constant attention, including carefully monitoring disbursements, investments, and expense forecasting to ensure the security of the association's assets and the best hope for achieving long-term goals. An active board, a dedicated treasurer, and a well-informed and knowledgeable property manager are the most important components and should help your properties reach their financial goals with the best chance of success.
Great. Thank you, Rich. Thank you, Maria. So at this time, if you have any other questions that come through, I know we've tried to answer a few of them as we went along. I was trying to keep up with it. There are a few that we didn't get to. Some of them were specific questions about their policy. So those I'll just tell you, I'm going to table those a little bit, so they're not done in the webinar, but we will try to get back to you, take a look at what your individual policies are, and if you have any comments on those, we can try to get back to you. So in the meantime, if there's any other questions, we're happy to answer them. But I guess I have another question for Rich, if you don't mind. You know, we talked a little bit about some of the different options you have: market-linked CDs, step-up CDs. Are there any other investment vehicles other than CDs that you see people using that could be an option for in the right situation? That could be another option that's commonly used other than CDs or some of these other kind of you know, these different CD options.
Right. Another area sometimes is U.S. Treasury investments or government agency investments, but those that would be considered, that would be rated AAA. So I think historically within the industry, besides CDs, FDIC insured CDs, U.S. Treasury, U.S. government obligations, or again, these government agency investments that are out there also could be appropriate. It appears that in many cases, certainly on the shorter end of the yield curve, the CDs seem to offer the best value and the best return right now. But that is another area that I do look at and have under consideration for the properties that I work with.
Great, great. Okay. So I think we're doing pretty good here. We have a couple more minutes if you have any other questions. Rich, do you have any closing comments there or anything in summary that you'd like to add? And I'll ask the same for Maria if you have anything that you'd like to add. And
all right. Yeah, Joe, thank you. No, I really appreciate the opportunity to participate. I think this is really an important topic for every association, out there. And hopefully you came away from today's webinar with a couple of good ideas, a couple of good thoughts. And hopefully that'll add some value to the properties that you live or reside in or manage going forward.
Yep, I agree. Hopefully there's some takeaways. One last question from the audience, and then I'll ask Maria first if you have any closing comments or anything that you'd like to kind of summarize and add.
Sure, thanks, so. So I think the top two main points that I wanted to just kind of highlight is, the fiduciary duty of the board, and also, it's a collaborative effort, So with written investment policies, it shouldn't be just the board members investing, association money with their interests. It's more a collaborative effort between, all the unit owners and also, the professionals involved, and just to maintain, and review their investment policy whenever they can. I hope is what they took away.
Great. All right, so I think we'll end with one last question. There was someone who asked about mutual funds, and if you had any thoughts on mutual funds, because I think that's a common question as well, and,
right.
And what your thoughts are on that. So.
Okay, yeah, it is. Yeah, as far as mutual funds, I would say that mutual funds would not be appropriate for a homeowner association. The main reason is there is no maturity date. So the issue with the mutual fund, while it may be appropriate for an individual investor, and there are some mutual funds that might invest very, very conservatively, the reality of it is that a mutual fund is an ongoing investment strategy within itself. And because there's no maturity date, you don't know that you're going to receive back a certain amount of money at any point in time. And I think that adds an element of risk that associations typically, shouldn't take. The one benefit of investing in a security with a defined maturity is that as long as you wait until that maturity date, you're going to get your return of principal. And I think from a fiduciary standpoint, that has to take the primary, that's a primary focus. Again, versus an investment like a mutual fund where you could be exposed to a loss of principal and also not having your principal returned at any point in time unless you sell the fund at its current value, which could be less than what it started at.
Okay, great. Thank you.
You're welcome.
Okay, so I think that's going to conclude the program for today. Like Rich and Maria said, hopefully you had a few takeaways you can take back to the board. Our contact information is on the screen. If you have any questions at all, feel free to contact any one of us. We'd be happy to help you out or kind of help you navigate through the process. Like I said, we'll go through some of the questions. Some of them we didn't get to, but we will. Rich, Maria, and I will go through them all and make sure that we respond appropriately. So thank you all for joining. And hopefully we see you again in our next webinar. So keep an eye out for other things we have going on, the firm newsletters, webinars, and other training and board evaluative material. So thank you again, and hopefully see you soon.